Well, the stock market tends to anticipate what will be happening in the economy 6 to 12 months from now. I would say that the difference between Main Street and Wall Street is that Main Street focuses on today, whereas Wall Street looks toward tomorrow. So I think basically if we continue to see good to stronger than expected economic reports, then that will help support the stock market's advance. We have certainly not seen a second wave or at least a new virus come out of this, but I think Wall Street is anticipating that we are likely to get some sort of a vaccine by the end of this year, early part of 2021. Also with the antibodies that are likely to be introduced, there's continuous hope that we are coming close to some sort of a resolution medically to this virus situation. So I think that is adding fuel to this upward trend. Essentially, we're seeing a lot of the sectors that have been laggards being leaders today, energy, materials, financials, and I think the reason is that if the economy will be improving, then there will be support and pressure, upward pressure on these groups that have been underperformers since this bull market got started once again. So if we're starting to see groups other than technology, communication services, and consumer discretionary do well, then that would imply that the economy outlook has been improved. There is a pretty broad level of participation. If you look to the nearly 150 sub-industries in the S&P Composite Index, we're finding that about 90% of these sub-industries are above their 10-week moving average or 50-day moving average, and about 70% of them are above their 200-day moving average. So we're seeing a lot of participation from a variety of groups. Granted, the large tech stocks, the large consumer discretionary and communication services stocks are still the stronger groups that are in the front, but there are an awful lot of other groups behind them that are also moving above their moving averages. I think that the reason that some of the fixed income ETFs are seeing some outflows or at least some price pressure is because the Fed has told us that they want to be lower for longer. They want to ensure that this economic recovery takes hold, and they're willing to experience a pickup in inflation in order to do that. Obviously, higher inflation would imply higher interest rates, and since bonds are like seesaws, if rates go up, prices go down, then that would be a negative for the price of these ETFs. So I think investors are saying, you know what, we've had a good run with fixed income, interest rates now below 0.7% on the 10-year note. The question is, how much better can it be? So they're basically rotating out of these areas, anticipating that inflation will be a driver for higher rates going forward, and are looking to reinvest that money elsewhere. No, we're not expecting to see deflation, nor are we expecting to see a ramp up in inflation. For all of 2020, our expectation is that CPI, core CPI, will rise by 1.7%. Next year, up 2.1%, and in 2022, likely rise by 2.2%. So that's a gradual increase in inflation, certainly not a sharp upward spike. I don't think investors expect any kind of new information to come out of the Fed symposium. The Fed has said that they will do whatever it takes to support this economy. Interest rates are likely to stay low for a long time, and if there's any concern, it would be that they're allowing inflation to pick up. But still, Fed watchers love to listen in on these meetings, and so we will get some news out of it, but I don't think it will move the market.